What's up, guys? I hope you're doing well. So basically, looking over the current state of the economy. In this video, we're going over part of the speech from what's his first name? I think it's Patrick Harker, the Reserve Bank president of the Philadelphia branch, I believe, for the Federal Reserve System. But we'll go straight into the screen share of the transcript. And he actually put some like decent facts in there too. It's pretty helpful. I think he gave this speech into a in front of a university. Actually, scroll up to the top maybe. Yeah, Patrick T. Harker, Rider University, in Lawrence Township, New Jersey. Um, might be a smaller college. I don't know. I've never heard of it, but it doesn't mean much. So, um, one of the things that he states is, I have to say, given these extraordinarily trying and tragic circumstances, one can't help but feel a little bit of awe at the underlying strength of the U.S. economy, as every economist probably says, or at least one in the federal government. Or I know the Fed is technically not a part of the government, but it's kind of it's kind of a pseudo part of it almost. What do they say? It's like it's independent within the government, whether it's and I go into the whole structure and everything else. That's a whole talking about that exclusively is what is I have a couple videos on that alone. And also posts on my website as well. Kind of just going through it as I was learning it myself. And I have pictures and stuff in there, so I'll leave those to be kind of references if you want to learn more about the, kind of the nuances in it. But like some of them are appointed by uh, president, and some of the other directors are not, and they're appointed various different ways. And I go into that, but anyways. So in the fourth quarter last year, coinciding at least in part with the Omicron surge, GDP grew at an annualized rate of 7%, with a strong inventory investment and healthy demand for capital goods. For the totality of 2021, US GDP growth was a very healthy 5.7%, right? And so I guess if we're just going to ignore the fact that it went pretty much straight down for quite some time because we shut everything down, but just because, and think about it, annualized rate. So 1 year ago was April 2021. Um, and then, I mean, we were just coming out slash in the middle of the pandemic and everything else. And so it was kind of GDP wasn't in a very strong position at that point. And so any growth seemed a lot more significant. Now, whether or not we're back to the same level of that we were before, I'm not 100% sure. One way to find out. That is not the graph I was wanting. Um, let's see. This is one that I will defer to a different video on just so I don't waste your guys' time. I'm sure you guys don't want to watch me just sit here and go over it. I guess I can. Hold on. Can I just switch tabs? Does that work? Hold on. Cool. I didn't know you could do that. And I'm relatively new to StreamYard, so you guys get to watch me learn the software itself as well. But this is what I'm talking about. Like, not really talking about GDP in general, but like how the negative 3.5% change in 2020. So it took a massive tank immediately, and this doesn't even go the whole way. It looks like is this just like the beginning of 2020? This is annually. Yeah, annual. Okay. So that's not really what I was directly wanting. Just kind of wanted to show how it went down. This might work. The Fred charts are normally pretty good when it comes up. Here it is. So this is what I'm talking about. So we're kind. It seems like we're almost coming back up to trend. So maybe, but this is this dip that I'm talking about, and this is extrapolated so far out. So we'll zoom in on the time. If you guys don't know about these things, the Fed charts given by the St. Louis Fed, you should definitely look into them. They can be very helpful. But we went. Let's see, Q4 2020, right here. So either let's see. So we go from, let's say 21 and a half down to 19 and a half. So two, we're going to say this is what, and this is in billions. So we're looking at trillions, right? So we go from, we'll just say down $2 trillion of GDP from Q1 to Q2. So that's it's like a 10% correction, almost just under, because we're technically not up to 20. Um, and so that massive dip, and then kind of just we're returning to trend, right? Because with these things too, when you're looking at like whole economies, um everyone bases, like, think about it, you're basing stuff off of rates, right? Why do people care about the CPI? Because it shows the rate of inflation. It's not like the total amount per se, it's showing you how much it changed relative to the previous year. That's why you're showing. That's why they say like year over year CPI or annualized CPI or whatever, is you're talking about a yearly rate, not a set amount, right? And so even with their whole price stability target, um, where they're saying it's like CPI should be 2% per year, that's 2% compounded year over year. And so each year, that 2% is a larger actual amount of purchasing power, or whatever you want to talk about it as. So let's switch back to that tab. Cool. Let me double check to make sure it actually switched correctly. Yep. Cool. I didn't know StreamYard had that feature. That's kind of cool. But anyway, back on the job market, or going to the job market, I should say. Half of the Fed's mandate, you'll recall, is extremely robust for 11 straight months. New job creation has topped 400,000. But if you think that has led to a decline in the help wanted signs, you're wrong. Even with all this job creation, vacancy rates remain elevated, right? So, yeah, I mean, it's the same kind of argument. I mean, we're coming from that deep base or whatever, where so many jobs were lost. Um, During the pandemic, to where it's like, how much of the job creation was actually like new jobs, or was it just people going back to old jobs, or jobs that were left vacant or considered non-essential are now being filled? And I don't know the exact numbers on that one, but like that's a question that should be answered, pertaining to this. Not, I mean, this is a speech, so it's like he's not going to go into full on like PowerPoint presentation mode and just go over everything. That's not the point. So you shouldn't expect it from a single speech, but that's something that should be answered, at least. Um, so again, or something else, nominal wage growth, as one would guess, given these conditions, has been strong, though it has recently not kept up with inflation, which is why he brings up nominal wage growth and not real wage growth. Labor participation rates are edging up as well, though they remain below where they were before the pandemic. Labor force participation rate is lower than it was. Big surprise when you give people an incentive to stay home. Um, but the bottom line is inflation is running too high. They're concerned about this, and same with he calls it generous fiscal policies, supply chain disruptions, and accommodative monetary policy have pushed inflation higher than I and my colleagues on the FOMC are comfortable with. Um, and they're also worried about if expectations get unmoored, which is probably worse than the actual numbers themselves, because a lot um it seems like the difference between kind of hot inflation, I guess, is what they call it, kind of what we are now, and more like very serious bouts of inflation is psychology, where you actually have like the psychology of the actual populace itself kind of switches to where that Gresham's law takes place, and they realize that their money is worth less and less, and so they just try to spend it as quick as possible, and get whatever they can out of it. and it's kind of just like a downward spiral in terms of purchasing power, at least. Um, and yeah, the CPI print for year over year in March is up 8.5%. Um, Core CPI, which excludes food and energy, was at 6.5%. And so, yeah, we're starting to see much higher prints. And it's one of those things you have to keep in mind. The CPI is kind of a lagging indicator, right? Um, it's not going to show you kind of everything right now, I guess. Meaning, like, um, this inflation that we're seeing now is due to stuff that's happened, say, like a year and a half ago. And so if we just like stop everything, we're not going to see everything go down to normal or whatever you want to believe um, till another year and a half or so. Um, I forget the exact. There was a study done, I believe, and I can't remember if it was 6 months to 18 months. It was somewhere in there on like how much certain indicators lag behind like policy decisions and stuff. I'll have to look into that so I can show you guys, because I'll need to find where I read that from. But basically, they're slowly raising interest rates to do this. Methodical rate hikes, as he says. And of course, your typical central banker, you have to make sure you pay attention, or everything is data dependent on how it evolves, or some other phrasing of the same concept. Um, so, which not necessarily saying that's a bad thing, it's just saying that's all they say. Um, so there's that. They also anticipate that we will begin to reduce our holdings of Treasury securities, agency debt, and mortgage backed securities soon. While the Fed cannot do much to ameliorate the supply issues that are increasing inflation, we can begin to affect demand, right? Um, Basically, lower demand from where they artificially increased it by monetizing all the fiscal spending. Um, and in some form, I guess you could say with their asset purchases too, because if you really want to talk about QE, it's just like an asset swap where they're swapping on the bank from the perspective of a bank's balance sheet. All QE does for them is basically change their treasuries to bank reserves. Pretty much it. Um, and then QT is vice versa. Um, but anyways, um, and again, they're kind of more in the disinflationary camp, at least what they're talking about, where inflation is still higher, but it goes down. So it's still positive, not saying deflation, but the rate of inflation goes down still. And they say that it should be, let's see, inflation should begin to taper this year too, though remain elevated, probably around 4% for 2022. The following 2 years should bring it back down to 2%. So we'll see. We'll see. Um, I'm definitely not going to come out here and give some like political argument and like, no, we're going to see hyperinflation or whatever the argument is. Because there's one of those things you have to realize there are a lot of cross currents in this stuff. And so not only do you have what the Fed does, but you also have like market implications too. And so like the supply constraints that he's talking about, that takes in a factor. And like, what are certain aspects of like the bond market doing? Like I've seen some arguments, specifically with Eurodollar University, and the whole bond market side of things, to where it's like, the bond market is saying a completely different story. And that basically this inflation is transitory, according to them. But I'm not going to pretend to articulate that argument very well, because that's one of the ones that I'm trying to really understand. Because really getting into the weeds and like money markets and like the bond market and stuff like that, it's not necessarily my forte, but it's definitely something that I've been looking into, just because I think it's interesting, and I'm just trying to learn more about it. But so there'll probably be future posts on that too, as I try to teach myself. But anyways, that's all I got for you this time. And so I hope you guys have a good night, and I'll see you on the next one.